as the output of the rising of the rates, not just, what rate it has to get to.
Alan, it was great to see you. Alan Schwartz there. He's the executive chairman over at Guggenheim Partners, helping us set up our coverage into Bloomberg surveillance, standing by with our Big Fed special coming up after the break. Diane Swamp, Bill Dudley, among some of the guests going to be featured on that special. Stick with us. We have full market coverage of the Big Fed decision at the top of the hour. Of course, the press conference coming a little bit after that, and the market reaction that occurs subsequently. Live from the Beverly Hilton in Beverly Hills, California, this is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decide starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Begins right now on TV and radio for our audience worldwide. This is Bloomberg Surveillance. Good afternoon, good afternoon. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrell. About 28 minutes away from potentially another rate hike from the Federal Reserve. Looking at an equity market that's positive by 0.4%. TK25, and then what? It's the pause. just around the corner.
But in the statement, John, you're more interested in the statement. I'm more interested in the presser. We'll see the different nuances there, including our wonderful Michael McKee there as well. What I would suggest going in here is the stagginess of the last 48 hours, and you see it within the data checks we're going to do today. And Liz Ann Saunders of Schwab featured this earlier. The difference between the T-bill yield and the benchmark, this is important. We've never been here. Is the inversion that we're seeing on that very wide spread of 3-month to 10-year. So it's a we've never been here moment for Jerome Powell.
The overwhelming consensus coming into this decision is one and done. One more hike at about 2 p.m. Eastern time and then done. For how long, I've got no idea. It is a two-part story, as Tom indicated. It's the statement, then onto the news conference. The news conference about an hour from now. Lisa, within the statement, there is this one line in the third paragraph. We're all very familiar with it over the last couple of weeks. The committee anticipates that some additional policy firming may be appropriate. Does that go, and what is it replaced with?
Given the fact that people are talking about a conditional pause, which I think we're all going to grow to hate very quickly because it means basically whatever you want it to mean, I do think that what I am looking for is dissent. I want to see whether there are people on both sides that think the Fed is doing the wrong thing, whether it's raising rates, cutting rates, or holding rates, and what that means for where the balance of weight really is in the Fed going forward.
Key phrase there, Bramo, and I'm with you. Both sides. Tom, the potential for dissent in either direction over the upcoming meetings.
I agree with this.
Could be pretty interesting.
It is wildly symmetric either way, and the ECB to me tomorrow is different. And I would say, folks, this is important. You've got to combine this afternoon event with what we see tomorrow with the ECB.
Let's get straight to it. Before we get to the ECB, we've got to deal with the Federal Reserve. Your equity market right now, just about positive, struggling to deliver any gains on a week so far. This Wednesday, positive by 0.35%. Yields about 4 basis points lower on a 10-year, 3.38. In the FX market, Lisa, the dollar showing some weakness. Euro dollar 110.47.
I love this every day, showing some weakness, showing some strength. Always 110. It's been at 110 for pretty much a month now. Here's how we're going to play it out through the rest of the afternoon. We have coming up KPMG's Diane Swank. She is going to speak with us heading into the Fed decision, along with TD's Priya Misra and Deutsche Bank's Matthew Lizzetti. That will be leading up to that 2 p.m. decision. Then immediate reaction from former Fed Vice Chair Rich Clarida, Bank of America's Michael Gapin, and Apollo's Torsten Slok. A real focus there, perhaps, and any tea leaves with respect to some of the lending conditions. And finally, breaking down Chair Powell's news conference, former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg. John, it'll be an interesting day of nuance, not necessarily massive surprises, I would think.
Hey, we'll see. We'll see.
I know.
I'm not there. I think we could see. I think Kit Jukes was right this morning. There could be some surprises.
We haven't mentioned the banking stress in the first 5 minutes of the program, and that's something we need to talk about, Lisa, through today.
And do they have some sort of insight into that? That's also another issue.
Oh, they definitely have insight into it. They know to the minute the deposits and the balance sheets of 20 or 30 banks out there.
And possibly some sort of preview of that senior loan officer opinion survey, which we're all really curious about. If they do, that's really what people are going to parse.
They're going to make that data more regular. I feel like we've been talking about that for months.
Did you just call that a barn burner?
Oh, yeah. I can't wait. It's like the minutes.
Tom's taking the day off. TK's not going to be around May 8th.
I thought you said you were taking the day off.
A few loans. I mean, that's where we are.
Diane Swank joins us now.
Please.
One of our favourites, chief economist over at KPMG. Diane, wonderful to start the programme with you. Let's start with a statement. It comes out in about 24 minutes. Most people expecting a rate hike. One, are you? And two, how do you expect the statement to change in about 20 minutes?
Yeah, I think they do have to be nuanced, although nuance is the word of the day. That said, first, I think they have to leave the door open a crack to additional rate hikes, even though I think they intend to pause, and they hope this is the last rate hike of the cycle. The reason they're going to be leaving that door open just a crack is because we've got inflation that looks like, at best, it's moving sideways, and that's not enough for the Federal Reserve. I think we also could see a dissent at this meeting. Austin Goolsbee has sort of staked out his ground on this already. This will be the third official meeting that he votes at. And I think one of the things he's very concerned about is that the tightening in the pipeline will do the heavy lifting for the Fed, and that they can't calibrate policy, and they don't want to go too far until they know more about that. And you're absolutely right, the discussion you had earlier, that they've already got a preview of not only what the deposit flows and leaving in and out are within the banks, but more importantly, that senior loan officer survey. They've been talking to everyone they know to find out how much credit market conditions are likely to tighten.
Diane, a number of months ago, we had the most fascinating National Association for Business Economics meetings in Washington. I thought the debate was as vigorous as I've ever seen. The debate at the Fed, are they relying on theory or are they making it up as they go?
Well, you know what? There's a little bit of everything in this. I think it's important to remember that there is no roadmap for where we're at. They are combating inflation. It is not 1994 where they preempted inflation and thought they could fine-tune the economy. So I think that's a really bad threshold for a soft landing. But I also think it's important that even though we're combating inflation, it's not the same as the inflation of the 1970s and 1960s, although they want to avert the mistakes of the era. And that seems to be their focus. And I think that's what is important is the majority of the Fed, there's a growing minority that are worried about how much they overshoot and that they can't calibrate a mild recession. And even mild recessions can be difficult to recover from. That said, this is a Fed that has put in their summer of economic projections enough of an increase in the unemployment rate to consider it a recession. And that's what they think is necessary to derail this inflation.
I remember an entire month and a half ago, we were all really worried about the Fed possibly signaling some sort of issue in the regional banking sector, and then that spurring some concern. No one's talking about that. Diane, is the Fed concerned about the messaging of raising concerns about the regional banks, given that they want to express some confidence in their strength?
They've been very consistent in terms of they want to stand behind how solid the whole overall banking system is, and their message has been very clear on that front. I don't think they're going to waver on that. That said, I think it is fair to assume that additional tightening in the pipeline will do much of the heavy lifting for them. And I have a little empathy for the position that Austin Goolsbee has laid out, where he sort of put a we'll see if he actually executes on it. But I don't think he's the only one in the room that would like to see the Fed wait a little bit and keep the door open to additional rate hikes, but see how much additional credit tightening there is in what could hit the backbone of the labor market, and that is businesses less than 250 employees. They accounted for a record-breaking 70.9% of total job openings in January and have since lost some steam. The biggest loss in job openings as of end of March was in businesses with less than 10 employees. The important thing for the Fed is how rapidly does that credit tightening sort of act like a boa constrictor? Is it slow squeeze on the overall economy and slowly slow things down, or is it more abrupt? My guess is it's more like a boa constrictor at this point in time.
Diane, unfair question. How many more banks need to fail before that position is just untenable at the Federal Reserve?
I really can't even answer that. I can't even begin to, for a multitude of reasons. But I think what's important from the Federal Reserve's perspective, remember, we saw a lot of bank failures in the early 1980s as well. And I think from the Federal Reserve's perspective, what they need to see is how much credit tightening is really in the pipeline as a result of the financial market turbulence we've seen. That's very important. And what I'm concerned about is, although they're getting all the readings and they're going to get a preview to that May 8th senior loan officer survey, we still won't know what actually happens until it happens. This is a Fed that said it's data dependent. Data dependent data is backward looking. I think it's important that they take into account how much they think is going to come in terms of rate hikes. And the question I would ask Chair Powell is, how much do they think credit tightening in the system already in the pipeline is likely to be equivalent to in terms of Fed fund rate hikes? He said sort of about 0.5% at the last meeting. That's a question to ask him.
Diane's brutal. I mean, she's worse than McKee.
Just teeing up the news conference.
She's just, I mean, I hope everybody's at the news conference. Leisman's over there. What did Diane say on Bloomberg? That's a brilliant question.
Of course.
You know.
As is everyone else. Diane, thank you. You're going to stick with us, I'm pleased to say. Diane Swank of KPMG. TK, the decision about 18 minutes away.
And you mentioned this today. I don't remember the context, but you parsed that the economy is small business as well. And Diane Swank was absolutely brilliant there on the smallness. Employees of 10, 20, 30, they're working off charge cards. They're working off maybe a loan that's three months behind. I think the tensions out there, to Goolsbee's point, are a little bit greater than the macro babble you're hearing at Bloomberg.
Fantastic conversation coming up. Diane Swong, TD's Priya Misra, Deutsche Bank's Matt Lazzetti, with your Federal Reserve decision about 17 or 18 minutes away. The news conference follows that about 30 minutes afterwards. Your equity market slightly positive. This is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
We have the Federal Reserve today, obviously.
Likely one and done.
One and done?
One and done.
One and done is probably the answer here.
They're going one more.
It's going to be a Fed that says, okay, look, we've delivered upon our dots. We remain data dependent.
They have said that they're very data dependent.
Seems like they're very focused on lagging indicators.
The Fed has its credibility at stake here.
And it gets really complicated.
If they're viewed as hiking into more banking failures, right, this is putting more pressure on the banking sector.
They're now moving towards a pause.
But really, enemy number one here is still the inflation picture.
There is no way that the Federal Reserve is not looking at the set of problems that they have right now and getting very nervous about where they're going to have to put their chips.
One and done. This is the countdown to the Fed decision on Bloomberg TV and radio. I'm Jonathan Ferro alongside Tom Keene and Lisa Brown. It's about 15 minutes away with the market shaping up as follows. The problem for this Federal Reserve is they say pause and this market hears cuts. On the S&P 500, positive 0.3%. On the Nasdaq, positive 0.03%, and a bounce back for the regional banks and the small caps, the Russell, up by 1.5%. Into the bond market, 2-year, 10-year, 30-year. Take a look at the 2-year, 3.92. The last time the Federal Reserve met, March 22nd at the close on a 2-year, where were we? 3.93.
Oh, nothing's happened.
Nothing's happened between then and now. Looking at the 10-year, down 5 basis points, 3.37. And just to wrap things up in foreign exchange, Bramo, looking at the single currency, the euro, guess where?
Yeah.
Go on, guess.
110.
Something
Let's
like
guess.
that.
Yeah.
Something
it's
like
pretty
that.
much.
110,
Honestly,
110.
Can I just say, Diane Swonk was saying, will Fed policy act like a boa constrictor? And I'm thinking about that as really being a perfect analogy. Is it a boa constrictor or is it a grizzly bear, right? Is it something that slowly contracts the economy, or is it come in with claws and just tear it apart? I don't know. I think that's really good.
Slow. Maybe, and then all at once.
Yeah.
Perhaps. No one knows.
This is important.
No,
this is
I know, but it's a good analogy.
Diane Swonk knows this, and so do Lazzetti and Misra as we bring them in. John, you're absolutely correct. It's slow, and ex post after the fact, and then they go with a vengeance because they're after the fact.
2 easy things to say today. Yeah. Here's one. Okay, here's one. We're data dependent. I think that phrase is the greatest cop-out in Federal Reserve conversations I ever hear.
I can think of a few others, but
it's meaningless.
Okay.
And I'll tell you for a few reasons. Dependent on what data and how much weight do you put on each data point? When you talk about the totality of the data, the balance between what and what. Now, are you looking at financials, the financial system, financial stocks, stress, the data from last week, CPI, unemployment,
Hold on a second.
payrolls?
Public service announcement.
What
We
is
all
that?
have heard all of these phrases so many times
just,
that
you know.
I am completely with you, and I think it's
But
good.
he's
It's
going
well
to
taken.
say it in 40 whatever minutes time. He's going to say we are data dependent. Everyone's going to go, he's data
Yes,
dependent.
Lizzetti's going to go, are you kidding me?
He's data dependent.
Yeah.
It's meaningless. It doesn't mean anything. They've all got their different interpretations of the data anyway. If they were truly data dependent in some kind of mechanical, objective way, they would all have the same view on monetary policy, wouldn't they? Except they don't.
Herein lies the issue.
You're always data dependent by definition.
There's a level of
It's kind of
cynicism here.
meaningless.
My children are data dependent.
This is off the chart.
We're all data dependent.
Let
All
us
right, we're done.
continue with our guests. We've got Diane Swank with us here.
Tom's trying to keep us on the rails.
Diane Swank is here, and as we go to the meeting here in 13 minutes, Diane's begging, bring in Priya. Priya Misra joins us, TD Securities, and Matthew Lizzetti, Deutsche Bank. To have these three on with us pre-Fed is all I need to say about a great booking crew. Priya, let me start with you as well. Where's the 10-year yield, the metric that we're using here to guesstimate the inversion of 3 months 10s as Misra-like? Where's the 10-year yield 3 meetings from now, 4 meetings from now, 5 meetings from now?
Lower. And I think it's because the economy, to the earlier discussion, the economy is responding to the lagged impact of rate hikes. I think that's more the boa constrictor. But then you've also got the grizzly bear, to use Lisa's analogy, because you've also got the banking sector that's in contraction. I think there has to be massive bank deleveraging. We're in the midst of that. That's going to accelerate.
Yeah.
So you've got rate hikes. QT, I hope QT comes up a little bit today because it's tightening policy and it's not really talked about. So I think tight policy is going to slow things down. So we think the 10-year is going to be much lower. 3-4 meetings from now, we'll be talking about rate cuts. And not just 100 basis points, I think a lot more.
Just because of time period, I'm going to race to Matt Lizzetti. Or Matt, you've got the call of the year on a delayed recession. I guess we're finally to the Lizzetti slowdown, the Lizzetti recession as well. How restrictive are we right now? Diane Swank mentioned a number of minutes ago that we may be a lot more restrictive than we feel. How super restrictive are we?
Yeah, I think one of the most important things that we heard from Chair Powell at the March meeting was all these financial conditions indices that ignore bank lending conditions should probably be ignored, that we really need to account for what's happening with bank lending conditions, the Fed Senior Loan Officer Survey, credit conditions. There, I'm hoping we'll get a good read from Chair Powell today, but the anecdotes that we had in the Beige Book were that you do have probably a meaningful tightening that is taking place there. On our broad financial conditions index, you are basically at the levels that you begin to see around recessions. And so I do think broad FCIs, when you incorporate bank lending conditions, are at levels that are actually pretty tight at the moment.
Diane Swank brought up this issue of whether the Fed would answer any questions about how they measure the lag effects. And Matt, I'd love you to weigh in. Are you looking for something similar? Do we have a guide to understand how lagged the effects are and how quickly they're taking hold now?
Yeah, I think the Fed has a bit of a tension here. I think for so long they were arguing that because of the forward guidance that they gave for how aggressive the tightening cycle was going to be, that they front-loaded a lot of the financial conditions tightening, and therefore they were not as behind the curve. Now I think they're in an environment where they want to emphasize that these lags are still to come and playing out over time. I think what we've seen, certainly over the past day or weeks or so, is that these stresses in the banking sector are likely still there. They're likely still coming. They're likely still tightening financial conditions as we look ahead. And that is, I think, the reason why we expect it to be the last rate hike of this cycle.
And Diane, that is speaking about that as well. Priya, before we go back to Diane, I'm curious from your perspective about that idea, about the rate cuts and what the threshold to do that is. Is it a banking stress issue? And what is the threshold that's enough to get the Fed to act?
I think the threshold to pause is actually not that high. The threshold to reverse policy with inflation remaining high, I think that is a high threshold. And I think the Fed is going to go into the easing cycle kicking and screaming. I think the threshold is a few months of negative payrolls, and we're far from that. Does that happen by December? We think yes. But I would say if it doesn't, they don't cut rates, and they're going to be nervous about the economy slowing down. But I think they'll really need to see, some slowdown in the economy is an intended consequence of Fed rate hikes and QT. So I think we need much sharper decline in the economy for the Fed to respond. This is not going to be a preemptive Fed into the easing cycle. I think it's going to be extremely reactive.
What an interesting point. Dan, I'd love your view on that as well. Do you think the bar is higher for cuts or higher for the Fed to resume hiking again?
I think the bar is higher for cuts, and I agree entirely with that. I think another important issue to think about here is the Federal Reserve said that they would raise rates and hold them. They did that knowing and thinking that inflation would continue to cool, especially core inflation would continue to cool, and that would raise real interest rates and add additional tightening into the cycle. One of the concerns they'll have is, although I believe there's a lot of tightening still in the pipeline, and I hope we hear some of that from the Federal Reserve Chair today, I think the Fed has to think about what happens if inflation doesn't cool as rapidly. That means that real rates will not rise as rapidly as well. And that's why they may leave the door open a crack to additional rate hikes for the most hawkish on the Fed. The other side of this is what happens on the other side of what they call a mild recession. Hard to calibrate, first of all, once you get into a recession. Second of all, many of the mild recessions we've had have been very difficult to recover from, and there is a very long tail out there in commercial real estate, notably the office market, that as yet we see those office leases lapse. Even in the most occupied office markets in the country, like Houston and Dallas, where you have 60% occupancy at the moment, they're already officially at double-digit vacancy rates, and that's before they've got the largest backlog of office space in the pipeline they've ever had.
Matt, do you agree with that, that there's actually a higher bar to cut rates than to raise rates at a time when the market seems to have a different view? The market thinks that it's a given that the Fed's going to aggressively cut rates through the end of this year and into next.
I think no doubt it's actually a higher bar to cut rates. I think to get there, you need to see the unemployment rate rise materially. I think you need to see what are likely recessionary dynamics playing out. I do think that the bar to hike rates at some point later may not be as high as the market is currently assuming. While we expect that you're going to see this tightening of credit conditions take place due to bank lending standards, it's still uncertain at the moment. You know, we'll see what we get in the survey data, but so far it is, I think, still uncertain. And what we do see in the inflation data is resilience. It's been broad-based. We've seen core goods inflation pick back up. We've seen private rental estimates actually pick back up. And so I do think you're likely to be in an environment where inflation is sticky and the Fed is very heavily reliant on the credit conditions doing the work for them.
Priya, you're monitoring the markets, and nothing's more out of whack, as I mentioned earlier, than the 3-month, 10-year spread. I guess it's not stochastic. It can go ever more inverted. Is there theoretically a break point where a lower 10-year yield is just untenable versus an elevated 3-month T-bill?
I mean, I think at some point, if the Fed does not cut rates and the market's pricing in these cuts, I think the 10-year will struggle to rally a lot more. But, you know, we're talking so much about the Fed reaction function. It's the economic outlook that's extremely uncertain. In fact, when we talk about the curve, I think of what's priced in as a bimodal distribution. There's a view of the soft landing camp that the Fed is on hold for a long time. Then there's the view of the recession. And I think as the probabilities of these two scenarios change, that curve can flatten some more. I do think there's a limit, you know, minus 70, minus 80, I think on 210 starts to get to a floor. And then, you know, it's going to come down to if the Fed is not cutting rates, I think the 10-year will start to sell off because that means that soft landing scenario is more likely. We're very much in the hard landing. You know, everything seems to be pointing towards a slowdown. It's just timing that slowdown. And can the Fed get ahead of it? We think not.
Priya, will we see market reaction today? The last couple times it's moved one way and then it's moved another way 3 hours later. Same silliness, or do we get something profound today?
You know, I think Chair Powell's going to try and buy time. I mean, if he hikes 25, that's almost priced in. I don't think he's going to commit a whole lot to beyond that. So you would think that's not a big market reaction. But there's a lot of nuggets in the press conference. Does he brush aside the bank issue, calling it just a few bank mismanagement? That's a hawkish message. Does he actually say that inflation's much higher than the Fed thought? That's a hawkish message. Or does he talk about credit conditions? We think that senior loan officer survey, we don't have it. We think the Fed has it. Are they more concerned about it? That would be a dovish sign. And the market's skittish. I mean, we're moving 20 basis points on a daily basis. So while I don't expect a big market moving Fed, there's anything in there that's a surprise I think could move the market. And then we have payrolls to look forward to and CPI. And that'll, I think, bring the market back in line.
Priya, do you think he'll come anywhere near to accepting any responsibility whatsoever for what's happened in the banking sector?
I think not in terms of monetary policy. In terms of supervision, I think Vice Chair Barr's report did put the blame a bit on the rules as well as Fed supervisors, which I thought was very brave of the Fed. So I think they might refer to that, but not rate hikes are supposed to tighten conditions, and that's what they did. Why some banks were more impacted by others, I think that the Fed is going to push back. I don't think the Fed takes responsibility on that front, but certainly on the supervision front.
It's certainly not clean. It's a dirty way of doing it. But Matt Lazzetti, is this a feature, not a bug, of monetary policy?
Look, I think it's a feature of monetary policy. The Fed is looking to tighten bank lending conditions. They're looking to tighten financial conditions. I think the big surprise recently has been that they haven't tightened as much as anticipated. Credit spreads have been so tight. So this is, I think, a feature. I think it is pushing things in the right direction. Obviously, they don't want financial instability concerns, and they will deal with that to the extent that they can through other tools. But tighter financial conditions, tighter credit conditions is a necessary condition for them to be able to achieve their dual mandate objective.
Diane, I wanted to give you the final word going into the news conference, not just the decision about 2 minutes away. 30 minutes after that, Chairman Powell delivering that news conference. You gave us a bit of a tease earlier in the conversation, what you'd asked Chairman Powell. Can you elaborate on that, Diane? What you'd like to hear from the chairman today?
Well, I'd like to know how much they think there is tightening in the pipeline, and to emphasize something that Priya made the point of, is that it's a bimodal distribution, and that's why the Fed isn't concerned about the fact that some are expecting rate hikes and some not. That is, some are expecting a hard landing and some are not. And the Fed is less concerned about that. But I think the most important issue we want to know right now is how much do they see credit tightening conditions tightening. I think it's easy for the Fed to say we're divorcing combating inflation and rapid rate hikes from financial stability, but breaking up is hard to do. And in fact, the Fed has always used rate cuts as a form of stabilizing financial markets. That's not an option when they're combating inflation.
True. Diane, thanks for being with us. Alongside Priya Misra, Matt Lazzetti, Diane Swank there. We are about 60 seconds away from a Federal Reserve decision. Live on TV and radio, special coverage will continue. 30 minutes after that, we'll have a news conference with Chairman Jay Powell. TK, what are you looking for in the next minute?
What I'm looking for in the next minute is definitions of pause. There's 18 ways they can say pause. I hate this phrase, hawkish pause. We're going to have a hawkish pause.
Got no idea what we're going to get.
A dovish action. It's just a primal scream to not do what your mandate is and to go somewhere with a slower U.S. economy. And the bet's out on this. I mean, you take Ed Hyman, he's looking for second half recession, much like Matt Lazzetti, and you look at Neil Dutta going completely the other way.
Bramo?
I'm going to look for control-find regional banks. That's it. I'm going to look for control-find lending standards, control-find credit tightening. I want to understand what they know about this.
Decision 15 seconds away. Here's the price action going into it. Positive 0.3% on the S&P 500. Your bond market shaping up as follows. 2-year, 10-year, 30-year. The 2-year, 392.84 on a 10-year yield, 337.49. With the decision, here's Mike McKee.
A hawkish pause. Fed officials, as expected, raised their target rate by 25 basis points to 5 to 5.25%. But they go on to suggest that the longest and the steepest tightening cycle since the 1980s may be about over. The statement drops wording anticipating some additional policy firming, now saying the committee will closely monitor incoming information and assess the implications for monetary policy. In determining the extent to which additional policy firming may be appropriate, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. The vote was unanimous. The economic summary notes a modest pace of growth in the first quarter, robust gains, job gains, and still elevated inflation. Lisa, don't worry about the control search function because there's no change in their estimate of the financial stability situation. They go on to repeat the U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. And finally, no change in the pace of QT, still capped at $95 billion a month. A short, sweet statement, but it does suggest that we are going into a possible pause.
Mike McKee, thank you, sir. Thank you, Mike. Let's whip through the price action for you. In the equity market, a lift on the S&P 500 up by almost 0.5% on the S&P. A move lower in yields at the front end by 5 basis points. Call it 6. We're down to about 390 on a 2-year. Let's just get to the FX market just briefly. Guess where it is, Bramo? Euro dollar.
I guess that the dollar is 110.
110. Yes. 110.74 on the euro against the US dollar. You see the move there. Much stronger euro, much weaker dollar off the back of some of this, reflecting the move lower in yields. So just to summarise what Mike McKee just went through, third paragraph in a statement, that one line in the last meeting we're all talking about for so long, the committee anticipates that some additional policy firming may be appropriate. Replaced with this, so I'll read through the quote again for you. The committee will closely monitor incoming information and assess the implications for monetary policy in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. TK, just a little bit to get through there.
A little bit to get through, and maybe a sea change, a little bit of excitement here, but it gets us to I want to count the number of questions in the press conference where he doesn't have a prepared statement. I think that's maybe easier to count than the ones with a prepared statement. They're all going to be there, and they're going to be carefully written, to say the least. Someone that's written those statements, Michael Gapin, joins us now, head of U.S. Economics at Bank of America. And joining us at our headquarters, Torsten Slok, Chief Economist, Apollo Global Management. Torsten, let me begin with you. You do these wonderful vignette notes. Which of your little vignettes describes the American economy Jerome Powell has to deal with? Which is the latest thing you see at Apollo that matters to Jerome Powell?
Well, I think what's really interesting in this statement is the weight on the highly uncertain effects of the banking crisis. And on the other hand, they are very explicitly saying the committee remains highly attentive to inflation risks. So it's still this incredible laser focus on inflation. And I do think that inflation in round numbers at 5% is still way too high relative to their 2% target. So they're still looking in the rearview mirror and saying, we just don't know quite yet how bad this banking crisis is going to be, and we just don't know, therefore, how much credit conditions are going to tighten.
Michael Gapin, I would talk to you about the banking crisis, but you'd probably walk off the set with a hook for Mr. Moynihan, so we won't go there. Michael Gapin, I want to talk to you about Fed policy, and I want to get right to it off this press conference. What will we learn about the June meeting?
I think that the main thing on the June meeting is we can't rule out further policy rate hikes. We don't think we will need to raise rates. We think we're done, as Torsten said. We want to evaluate how the ongoing stresses from the regional bank fallout are affecting activity. But the message will be we don't know entirely that we're done. It's possible that the spillover effects will be limited. The labor market will remain relatively solid, and we may have to do one or two more. We can't fully rule out action in June at this point.
Where are we going to be June 14th? Bramo, let's talk about it. Let's go through the statement. So this is what they said back on March 22nd. They were talking about the financial stress. The banking system is sound, resilient. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. Let's go to the new statement. Second paragraph. Same stuff. Banking system is sound and resilient. The extent of these effects remains uncertain. Well, that's one extra bank that's failed since the last time they said that. And I wonder on June 14th if they'll be using the same language again, Bramo, and how many other banks we'll be talking about at the same time.
And that everyone will agree. Do you find it interesting that there was no dissent, given the fact that we've heard so much dissent in all the talk that we've gotten from some of these Fed members at a time where there is a great deal of uncertainty, but pretty polarized views and strong ones at that?
I find it very amazing, Torsten Slok, that there is no dissent today, do you?
Well, I do think that their focus on inflation is really just continuing. I mean, they have said for a long time, we got to get inflation down to 2%. And the honest look at the data is that inflation is just not moving down to 2%. And now you on top of that have the housing market showing more signs of recovery. And that has a weight of 40% in the CPI. And if home prices and owners' equivalent rent starts to go up again, you could really have inflation sticky at very high levels. So I think they're keeping the optionality, the flexibility here at the moment.
Well, Torsten, you've said credit crunch is coming. You said credit crunch was here. Isn't that going to take care of it for them?
Yeah, so the problem is that the credit crunch is somewhat remote from the recovery in the housing market because the labor market is still strong. So there's all these domino bricks that need to fall in place before we need to see the labor market soften. And Jay Powell has clearly said we need to see the unemployment rate go up. And we're just not quite seeing that yet. We'll see on Friday where we get. But you're absolutely right. There's a number of things that need to happen first. And it's all monthly data before we can come to the conclusion that things are truly slowing down. And therefore inflation is coming down to their target.
Michael, can you weigh in on this? Basically, is the implication here that in the Fed's data, perhaps that we don't even see, the stresses in the banking system really are not that great, or it's really just been perhaps overblown by individuals like myself, and that actually the inflationary outlook is still the preeminent concern, even with the ability to possibly not raise rates?
I think that's a fair characterization in the sense that the statement says it is still the preeminent risk. That doesn't mean they're not worried about banking system stresses. They certainly are. They will show up with the lag. They don't show up right away. Our work suggests it could be 2 to 3 quarters, certainly a shorter lag relative to policy rate hikes, but it's not instantaneous. So I think they're in this balancing act where the macro data is still pretty good on balance. They think they're going to get some excess tightening out of banking system stress. Until they know where that lands, inflation is still the number one concern. I think that's what the statement's trying to balance at this point.
Torsten, to Diane Swank's question, how do we measure the lag effects?
Well, one data point we get next week, which is the Fed Senior Loan Officer Survey, is at least one very important observation in getting how bad was it actually here in the latest data. And meaning we already get some information about the second quarter telling us what are banks' willingness to lend. Did they tighten lending conditions to large firms, to small firms? Overall, that will be a very important, at least, step on the way to figuring out how severe this is. But it's very clear when you think about it. I mean, the 14th and the 16th bank in the U.S. having, unfortunately, to collapse and go under. I mean, 2 balance sheets of more than 200 billion. This is not just a small corner of the financial system. This is going to have a fairly significant impact. And as Michael was saying, the risks are that now financial conditions in the regional banks, of course, will tighten. And with the regional banks or the small banks making up 40% of all lending and 30% of assets in the banking sector, this is something that you should be quite worried about the downside risk for the macro.
You know, every bank has a different fabric, Michael Gape, and I think Brian Moynihan loves the micro data of banking. With the reach you have at your institution, what's the temperature that you take of the banking into the real estate system? How does that work into your weekly note or what you're going to write off of this Fed meeting?
I think if I could also just pivot a little bit off of what Torsten said there in terms of next week and the tightening in the Senior Loan Officer Survey. Does it stay focused on commercial real estate and C&I lending, or does it migrate into the consumer and, to your point, the residential real estate market? Because right now there is a bit of a split. It's tightening towards firms and commercial real estate, but not so much towards the consumer and residential mortgages. The consumer is on better footing. The housing market domestically is frozen in its tracks a bit, but the banking sector is still willing to lend into that sector on net. So I think that will be key to kind of gauge the downside effects or the outlook from my perspective.
Second half of the programme, so now time for your useless slogan number 2 of the programme. It was data dependent previously. It is not 2008, which is the one that people love to say at the moment, Torsten. It is not 2008 because it makes you sound really intelligent, sophisticated. You lived it and you know that this is not 2008. It means nothing. Every crisis is different. Of course it's not 2008. It's ridiculous to even have the conversation. It means nothing. We're always benchmarking to the extreme. Always. We do it with tech stocks. It's not 99, 2000. Except bad things still happen. It's not 2008. I find that slogan, that phrase, useless. Let's park it. You said it's important. It is still not good. Banks are failing. 1, 2, 3, 4. Throwing Credit Suisse, make it 5. How big is this problem?
Yeah, so you're absolutely right. If you look at the CRE as a share of the economy compared to residential real estate as a share of the economy, it is small. In particular, CRE office is even smaller. But there are some indicators that are worse than in 2008. If you look at the University of Michigan question about what are your interests in buying a durable good, conditions good or bad, and the share of the population that's saying that things are bad because credit conditions are tight is now double at the level it was in 2008. So both for consumer credit conditions have been tightening, and the New York Fed also has a question where they ask households, have you been declined access to credit? That's at the highest level in a decade. So you also have, going back over the last 10, 15 years, that we have a situation, in particular when it comes to credit conditions, that things are not moving in the right direction. You could say, well, this is because the Fed is raising rates, but adding a banking crisis to the Fed raising rates is just creating this risk of a non-linear slowdown.
So, Mike, for a long time, the Federal Reserve has talked about acting ex post after the fact. Should they shift to ex ante,? 'Ex-ante, given essentially what's playing out before our eyes in the banking system?
You know, every bank has a different fabric, Michael Gape, and I think Brian Moynihan loves the micro data of banking. With the reach you have at your institution, what's the temperature that you take of the banking into the real estate system? How does that work into your weekly note or what you're going to write off of this Fed meeting?
Given essentially what's playing out before our eyes in the banking system?
Not until they get more clear evidence that inflation's coming down, and therein lies their conundrum, right? It's their primary focus. They have to get inflation down to 2. They've got uncertainty to deal with, so they can't be too preemptive unless they're going to, they risk missing then on their inflation mandate. So yes, at some point they may have to be preemptive, but I don't think we're going to get that message now.
Yeah, because by definition, data dependency is looking in the rearview mirror. So if you refuse to look out through the front mirror and not look at everything that's going on in front of you, you will, of course, focus on, as Michael is saying, on the past data and not so much on quantifying the very difficult issue we have in front of us.
I keep thinking about the boa constrictor and the grizzly bear. We were talking earlier with Diane Swank about the boa constrictor just kind of tightening around the economy. Mike, how quickly can the economy just absolutely fall into a downward spin? Or are we so far away from that type of recession, that type of downturn, that just doesn't seem probable?
Yeah, I'm sorry. I don't think that that's a base case, but I mean, to answer your question, right, it's the sudden stop theory of recessions is all about, it's when credit flow stops, that's your problem. So that could happen very quickly, meaning in a matter of a couple of months, you could certainly see that. We're not looking for that. Certainly, we think we're going to get some excess tightening out of the regional bank stress that will help slow the economy down. But I don't think a hard landing from us is a base case at the moment. The sudden stop theory would tell you, if there is a major credit shock coming, if it happens, forcefully and fairly uniformly across not just small banks but medium and large, then you're going to see those effects pretty quickly. We don't think we're in that world yet.
And I agree with that. I mean, the bottom line here is that there are many other sources of financing than the regional banks. Of course, private capital, there are market securitization, securitized credit cards, auto loans, and those other sources of financing have been able to pick up some of the slack. And thankfully, credit spreads are still at reasonable levels. So that means that the regional banks can be replaced to some degree by other sources, including private credit.
Can I give you both the final word on this? I've asked this question a few times today. I think we all have over the last couple of weeks. Do you believe that monetary policy objectives are in conflict right now with financial stability?
So at least from my chair, I mean, the way I think about that is that you cannot say that it's completely separate what's going on in the banking sector relative to hitting the inflation goal. Of course, hitting the inflation goal is about cooling the economy down. It's about cooling inflation down. And in that process, cooling the financial system, cooling credit conditions also involves an impact on banks and in particular, in this case, also on regional banks.
Mike Gapin, your take?
I would agree with that. The two are not entirely separate. Obviously, when you tighten monetary policy, it will increase the cost of credit, slow the growth rate of credit. That could put some institutions under stress. They're not entirely separate. I would associate with Torsten's remarks there.
Hey, Mike, great to catch up with you.
It's
Mike
really
said
wonderful.
in the last week or so, enough juice for one more hike, and we got one more hike. I love that line, Mike. You know that. Torsten Slok for Apollo. Torsten, great to catch up with you, buddy, as always. TK?
Right now, as we go to Bill Dudley later in the program, the former president of the New York Fed, we are advantaged by the former vice chair of the Federal Reserve System, Richard Clarett of Columbia, and of course, global economic advisor at PIMCO. Dr. Clarett, I just want to cut to the chase. You wrote an economist essay about the IMF meeting that I hope everybody at the Fed read, which is it's really going to be hard to get back to a 2% level. Where are we heading across the meetings of 2023 with the inflation dynamic you describe in your Economist article, and with what we see from the Fed? Where are we going to be in June and on to the December meeting?
Well, thank you for having me on the show, Tom. I guess a couple of points. I do think in the statement today, as I think others expected, they did adjust the language, and so they definitely want to have the option not to hike at the June meeting by including that language on the extent. But I do think this is a committee that will, and we'll see this from the chair today, I imagine pretty soon, is going to emphasize they're not declaring mission accomplished. Inflation is way too high. And certainly this will be, I think, sold, and they believe that it's a pause, and they're going to do what it takes. Now, looking ahead, I have written and do believe that, under a plausible scenario that the Fed has laid out in the projections, which I broadly agree with, inflation a year from now could be running in the 2s, but probably not near 2.0, probably north of 2.5, maybe closer to 3. And I think at that point, the committee will have to make a judgment. But if it sees progress on inflation, then it's shown in in the SEP projections, they think they can be adjusting rates downward. But I don't think they have to get all the way to 2 before you see those adjustments.
If we look at where we are with R-Start and the calculations that people like you make up to see what the path is forward, there are other ways within the system to be more restrictive. And of course, one of them is banking trauma. Are we more super restrictive now or more tight than the chairman realizes?
Well, I'm not sure what the chairman realizes, but I do think, and I certainly believe that what we've seen with SVB, First Republic, Credit Suisse, the cumulative effect of that, even if there are no more disruptions, will be to tighten bank lending. I think that's equivalent to some additional rate hikes. So whatever rate hikes you might have thought the economy needed, say, in late February, probably fewer now, because this is going to slow the economy. You know, Torsten, who I really respect, talked about the other markets for supply and credit, but a lot of small firms and businesses don't have access to those markets. So when bank lending slows, it'll impact a small business hiring and employment, I think, pretty substantially.
Given that credit interruption, do you agree with Diane Swank and Matt Luzetti earlier, who said that they think that the bar is higher to cut rates than to raise rates again after a pause?
Well, let me think through that. I think that inflation's just too damn high. It's not 3 point something. It's in the 4s. Whatever progress appeared to be evident in the data in the winter has now, if at best, stalled. And so, yes, I think this is a committee that is going to be very reluctant to ease until it really does start to see inflation moving down sustainably. And so I would agree with that.
So right now, as we look at this statement and we understand what you're saying, what more do they have to see in the banking sector in order to say, OK, hold up, this is something really serious that needs a little bit more scrutiny?
Well, I guess I guess it's an evolving situation. We've resolved 2 significant banks, resolved in the sense that they collapsed and they had to be acquired, facilitated by the FDIC. Look, let me say what I do believe. The banking system as a whole in the U.S. has enough capital, has enough liquidity, and is profitable. So this is not an issue about the banking system per se, but clearly there are fragilities among certain banks, in particular. In that category between 100 to 250 billion, and we may not have seen the last of that.
If you are just tuning in live on TV and radio, this is a special edition of Bloomberg Surveillance covering the Federal Reserve decision from about 20 minutes ago. They hiked interest rates 25 basis points. If you're interested in the language shift in the statement that we got from last time they said the committee anticipates that some additional policy firming may be appropriate. A couple of lines have changed around that. The line now reads, in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over the time, the committee will take into account the cumulative tightening of monetary policy. Off the back of this, your equity market positive on the S&P by 0.4%. That's on the S&P 500. In the bond market, yields a bit lower at the front end. Not a big move. That move phased just a little bit. We're down about 3-4 basis points on a 2-year, 3.92. Just to look at foreign exchange briefly, the euro stronger, dollar weaker off the back of all of this, 110.65. The news conference, you're laughing, aren't you? 110 euro dollar. You love that.
Yeah, it's great.
11 minutes away from that news conference. It doesn't seem to change, Rich. I keep saying the same thing. Rich, I just want to jump in on the banking stress. Your former colleague, John Williams of the New York Fed, has really played down the role the Fed has played in this by hiking interest rates from 0 to 5 so quickly in a little more than a year. I'm just wondering what your assessment of that is, the contribution of Fed policy over the last 12 months to what we've seen play out at the regional banking level.
Good question. I have enormous regard and worked closely with John for nearly 4 years. I think as a Fed official, he is careful in how he chooses his word. I'll just tell you what I think. I think in every rate hike cycle, banks that have exposure to interest-sensitive assets are going to face challenges. You know, in the case of First Republic, they held a lot of mortgages. Mortgages get hurt when the rates go up. In the case of SVB, they held a lot of securities. And so I think banks do maturity transformation. They borrow short and lend long. And when bond yields go up a lot, some banks are going to be challenged. And so I just think it's an inevitable part of monetary monetary policy. As I said, the banking system as a whole is sound, but banks that have big exposure to rising rates that they didn't hedge are not surprisingly going to get hurt.
And I can ask you this because you're the monetary guy. If you're the regulation guy, I couldn't ask you this, Dr. Clarida, but for you it works, and with your experience and your public service to the country, it's real simple. Everybody's scared stiff. LIBOR's back to where it is. This new SOFR's back to where it is. Kathy Jones over at Schwab is just out with where the FDTR rate is. It's back to where it was, which is 2006. Michael Spence was eloquent in 2010 about the regulatory failures leading into 07, 08, 09. Are we there again?
Tom, I don't think we're there. I don't believe we're there. What I will say is that, and I think the report that we got out of the Fed and the GAO, I certainly read both of them carefully, and clearly there were things that were missed, not so much in regulation, but perhaps in supervision. And I do think that we will see that changed pretty quickly, and certainly I think that would be a good idea.
Rich, you know the Federal Reserve, in your time there, has been heavily criticised over the last few months regarding this issue. Can you share some of your experience in your time? Did these issues ever come up at board meetings that you attended around the names that have failed over the last 2 months? Were these flagged in any way, shape or form at the board level in DC?
Well, let me just say this. I was surprised by both of these based upon my entire experience, and in particular, what I would say is there was a focus. It was in statute in 2018 that the Fed should tailor to the individual banks regulation and supervision. I think that certainly is important, but I think these reports do indicate that needs to be improved, and I think it will be improved, and it should be improved.
I guess another way to ask this, Rich, is just whether this goes all the way up to Jerome Powell in terms of his oversight of individual regional bank regulatory exercises. In other words, is he somebody who would have known some of the granularities here, just to give us a window into what that process is?
Yeah, I think I'll just leave my answer at that. Obviously, I've not been in the building for 15 months, and I'll just leave my answer at that.
All right. Well, just to give you a sense.
That brought the show to a pause.
Well, Rich, the reason why this is important is because people often think of these as independent items, right? You've got on one hand policy, and you definitely have an inflation problem. But John, you have to wonder if at a certain point you're kind of challenged if you have a regulatory mistake, I should say.
Rich, I don't think we're going to let this go. You were there. You guys knew that you were hiking aggressively. SVB's gone under. Signature Bank, First Republic, Silvergate. When you were hiking interest rates this aggressively at the Federal Reserve, was this on your radar? And Rich, if it was on your radar, why was nothing done about it in a sufficient way to prevent this from ultimately materializing?
Well, I was there in 2018 when we hiked rates up to 2.5% and paused at that level. I continue to say, as I did earlier, when I got a similar question, the banking system as a whole is sound. It has a lot of capital and liquidity. And so at a top-down macroeconomic level, it certainly was not then a concern.
Rich, what's so important here to John's question, and I know there was a pandemic and all of the estimation of the glide path of the great medical miracle of getting out of the pandemic, but a lot of cynics would be saying that well-meaning people have been basically practicing modern monetary theory with the Biden stimulus in whatever form it was, and now we're trying to extricate ourselves from it. How do we extricate ourselves from the Fed, the deficit, the debt ceiling, the other worries that our listeners and viewers have? What does he do in the press conference to help us extricate ourselves from this dilemma?
Well, I think there are a lot of moving parts there. I think Jay Powell is going to focus on doing his job, keeping at it till the job is done, but being attuned and attentive and sensitive to what we're seeing in the financial system. And I don't expect him to move beyond that. But Tom, you are right. The thrust of your question, these are all related, and obviously they all impinge on monetary policy.
This is the heart of the matter from the head of economics at Columbia University for so many years and what he did with Gertler. John, this is a Fed that has to get back to a laser focus on what the original mission was. Through the pandemic, there were all these other issues. The social policy that was, it's gone off in the crisis that we're in.
Let's be clear. That was driven by the chairman himself.
Yes, I agree. I totally agree. But the point is to what the former vice chairman is saying, they're going to get back to a more focused process. That would be one guess.
Well, let's focus on the next 4 minutes. In about 4 minutes' time, we will have a news conference with Chairman Powell. Rich, let's wrap it up there. What would be your focus going into this news conference, just as a spectator now from outside the Federal Reserve, looking at this play out?
Well, thank you for that question. I do think that the statement today will be helpful in that, because I do think the goal coming into the meeting, notwithstanding what we saw with First Republic, was to give themselves the option to pause. But certainly, I think the chair will stress that they're not. It's not mission accomplished, and they've got a lot of work to do. So I think we'll hear a fair amount of references to that, because I think he and the committee do want to guard against the pause being heard as done or pause being heard as rate cuts are imminent.
That sounded like a thanks for not asking me about the banks again, Ramo, I think. Richard Clarida, thank you.
Thank you so much.
The former Fed Vice Chair, wonderful to get your perspective on this monetary policy decision. Going into the news conference in about 3 minutes' time. 25 basis point hike delivered, widely expected. One and done, the phrase you've heard so many times coming into this. Are we truly done, Lisa? And for how long? Because you are never truly done, are you? There's always something next.
We're data dependent. I just want to tweak you.
Okay.
But listen, this is the issue right now, is what data, and that is really my question. Is it going to be the senior loan officer opinion survey? Do they already have that? And if so, what guidance can they give us? Oh, and if it's not that, how much are you looking at specific components within the inflationary reads? These are some of the issues, as well as, of course, the big elephant in the room.
TK, it's going to be an interesting 60 minutes, isn't it?
I think it is. I've said all along this press conference is going to be interesting in how he frames it out to the coming meetings here. What's so interesting is Professor Clarida alluded to is the wide set of issues here that are really outside the capabilities of this institution, and yet he's got to allude to them. Will he comment on them?
Well, there's another one, isn't it?
To see.
We haven't talked about it in the last 60 minutes, the debt ceiling. Nobody wants to talk about it, because what can you say? But ultimately, you'd have to think you get to the June decision, Elisa, and you could be at a very interesting point down in Washington, D.C.
How much is the debt ceiling debate tightening financial conditions in the very short end and making the job even more difficult around regional banking, because you're seeing those 3-month T-bill yields at the highest levels now, going back to 2001? Is this because of monetary policy? I don't think so. I think this is a debt ceiling disruption kind of issue.
Also, if you get the kind of spending cuts that the Republicans would like to see, Tom, you've got to factor that into your projections at some point as well.
That's clearly outside the scope of this press conference. But what I would go back to is their estimate of the real economy, and do we get any whisper of the knowledge they have? And McKee is very big on this. They have knowledge about the banking system on a day-to-day basis. It's like almost like military intelligence, far greater than anything we have. Does that give him a confidence here if he knows good things or not? The other way, I don't know.
And what will he choose to share? I think Lisa's been on top of this all along. May 8th, right?
Yeah,
May 8th, the Senior Loan Officer Opinion Survey we're all waiting for. You'd imagine, Lisa, he's got a decent idea of what that's going to look like when it comes out next week.
So how much of a preview can he give? Can he be like, it's, not that bad? Don't worry about it.
And John, the presser here, and I'm going to do this in 10 seconds. For those of you on Bloomberg Radio, it's a different view, a different set of wonderful flags at the Fed, the podium, the people lined up. It's a whole new set, a whole new look. I think taking after Lagarde, the set matters.
The site, Tom, it looks precisely like the last set that he stood at. Has it really changed?
I wasn't here for the last Fed meeting.
Doesn't look like it's changed.
They must have changed it last time around.
You're more detail focused, Tom. Maybe it has changed, but I can't notice the difference. We're waiting for Chairman Powell to walk into that room. A 25 basis point interest rate hike. Going into it, your equity market is positive by 0.4% on the S&P 500. The bond market yields are just a little bit lower by 3 basis points on a 2-year, 393. Yes, TK?
He's late. I mean, what's it mean? What's its signal?
What's his signal? What's his signal? He's going through the Senior Loan Officer Opinion Survey.
Just to make sure everything's okay. This is actually unusual. Usually he's pretty prompt. Have you noticed that? This is actually...
He could be on the phone with Goldsby.
I'm not going to read too much into Chairman Powell being seconds late. He's walking into the room right now. The Chairman of the Federal Reserve after hiking interest rates by 25 basis points. Let's listen in.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman. Oh, thank you. Yeah. Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about, the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you. Go to Victoria.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to. Before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could. Could you give us a sense of what the SLOOS survey indicated? It was already, I think, 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time, and that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle? As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that
that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process. I think we're going to need to stay at this for a while.
How does the other side of the mandate, the jobs side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number anyway. In any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down. And that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is, I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures. And then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others. And you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling?
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet. And now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, then markets have been from time to time pricing in quite rapid reductions in inflation. We'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. You know, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them, and that's kind of the only thing I care about is. And I feel like I am accountable for doing everything I can to make sure that that happens.
Evan?
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of is an important step toward drawing a line under that period of severe stress. Okay. I also think we are very focused on what's happening with credit availability, particularly with what you saw in the Beige Book, and you will see in the Sluice is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from MarketWatch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to be to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and you know, that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, you know, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, you know, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious, too, how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
That does it for the main news conference of the Federal Reserve, with Chairman Jay Powell there following a 25 basis point increase. Looking ahead on the economy, this is what he had to say. His forecast is for modest growth, not a recession. On policy, he was asked, is this a pause? We're getting closer. We're maybe there. We discussed it, but here's the important but. A decision on a pause was not taken today. Are we sufficiently restrictive? That's going to be an ongoing assessment. On cuts, Mike McKee pushing hard on that in the news conference.
See that?
The FOMC's inflation outlook, Tom, doesn't support rate cuts.
The only one in the conference where there was really a stumble, once again, was McKee. Always.
If you are just tuning in on TV and radio, this is a special edition of Bloomberg Surveillance, covering the Federal Reserve's latest interest rate increase with Tom Keene, who wants to go home, alongside Lisa Abramowitz. I'm Jonathan Ferro, who is very happy to stay with you. Your equity market on the S&P 500 is negative 0.3%. We roll over and fade just a little bit. In the bond market, yields down by 5 basis points. Keep it together, guys. 391 on a 2-year. Fade just a little bit there too. Bit of dollar weakness in the mix for you. Euro strength, the euro against the dollar, 110.57. If you are just tuning in, welcome to the programme. This is what the chairman had to say.
With our monetary policy, we're trying to reach and then stay at for an extended period a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that. This assessment will be an ongoing one.
The chairman of the Federal Reserve said policy was tight. You put credit tightening on top of that, throwing QT. We may not be far off or possibly even at that level when you get closer and closer to being sufficiently restrictive. I think, Tom, the chairman is struggling to reflect there a consensus on the committee.
Yeah.
Without drowning out that consensus on the committee with his own personal view. You could sense how hesitant he was addressing that question.
And for those of you on radio, there's a time where he looks down and reads the prepared comments, and we saw that 3, 4, 5 times, it seemed, throughout. What I would really emphasize, besides the decline we see, Dow down 200, SPX down 18, is how little the market moved during the press conference. Compared to the last 4, 5, 6 press conferences, I don't think there was the gyrations, the emotion within the conference.
Initially, people, Tom, described it as dovish. Lisa, I have to say, listening to that news conference, that's not my personal assessment of what I heard over the last 50 minutes.
Inflation is a preeminent concern, and that's clear. That said, the market has not shifted in its view that this will be the last cut in this rate hiking cycle that has been the fastest going back to 1981. We just witnessed it according to market pricing, and that from here, the next move will likely be a cut, and it could come as soon as September. And perhaps he had no conviction about pretty much anything, but he did sort of reflect the seesaw underpinning the debates at the Federal Reserve, at the FOMC, that just gave confirmation to markets.
Told you what their new focus was, though, right?
Yeah.
Credit tightening, Tom. It's going to be a big focus for this committee over the next couple of months.
This is the overlay of all these other events that are happening, banking, commercial real estate, et cetera. What does that affect on restrictive? And I've repeated this, I think, twice today. It goes back to Constable Mizuho and this phrase, super restrictive. How restrictive are we now? And some would suggest more restrictive than we imagine, just looking at the data.
I'm just going to put this out there. I suspect that the senior loan officer opinion survey is going to be really boring. And the reason why is because he made it sound that way. He had a written statement when someone asked him, what does it say? And he looks down, he's like, oh, I can't give you any preview, but just to think it's in line. And it's, probably we've seen this tightening since the second half of last year, and it's been ongoing, et cetera. So, but this
you enjoyed the last 50 minutes, I can tell.
I mean, I just was thinking to myself, all these people trying to get him to say something, and he's just like, look, we don't know. And we're doing the best that we can. I think the economy is in better shape than my colleagues. We all agree, though, and yay, kumbaya.
The most important headline from the whole thing, looking ahead, we will take a data-dependent approach to policy.
You predicted this?
We will be data-dependent. We will be data-dependent.
Yeah, well, let's do this right now. Let us jump to someone who's absolutely been out front on the trajectory of the Fed, and that is William Dudley. He's, yes, a Bloomberg opinion columnist, yes, a former president of the New York Fed, but far more a gentleman of Berkeley, steeped in our economic history. Bill Dudley, I've been dying to ask you this question. This word pause has come up, and the arch question to me, to get to June and on to the rest of what we observe in 2023, if they pause, is it asymmetric or symmetric? Does a pause mean rate cuts to come? Or they can say, we're going to pause and we can go either way. the historians, John Taylor of Stanford across the pond from your Berkeley, Barry Eichengreen and others, would they say there's a precedent to analyzing asymmetric or symmetric pausing?
Well, I think they can pause and then continue to tighten again if the data turns out to support that. But obviously, when they do pause, they're making a pretty strong statement that they've gotten enough information, that they're confident that policy is sufficiently restrictive, to use Chairman Powell's terms, to bring inflation down to 2% over time. So a pause is going to be a pretty significant event from the Fed. Now, obviously, context matters. If we're in the middle of a debt limit ceiling fight at the time of the June FOMC meeting, we might take a pause for other reasons. But I would say a pause will be a pretty important event. What the Fed was trying to do today was say, look, we don't know if we're going to pause or not at this point. The message, I think, in the statement and in the press conference was pretty clear. We think we're getting close to a level that's sufficiently restrictive. We're not absolutely certain.
Right.
The data is going to tell us that we have to do a little bit more. We're clearly not going to cut yet. So I think the pushback that the Fed is making is really to the market's pricing and rate cuts. The Fed thinks that the process of getting inflation down to 2% is going to take some time, a lot longer than what the market thinks.
I heard one word in the beginning of the comments, and it echoed from Lyle Brainerd. I believe she's at 1600 Pennsylvania this week. And the former vice chair would suggest cumulative. What is the cumulative effect of where we are right now, given how you nailed the need for higher rates to fight inflation?
Well, we're certainly in the vicinity of what's sufficient, I think, in my mind. Whether they have to do another, increase or two, it's hard to say at this point. We've come a long way in the last year. As Chair Powell said in his press conference, you go 500 basis points, 5% increase in short-term rates. That's a lot in a year. And we're also starting to see some of the effects of that on the banking system, so that the Fed has a whole nother source of restraint, which is credit conditions are going to tighten because some banks are going to pull off. Now, the hard part, as he said in his press conference, it's very hard to assess how important that channel is going to be. My own personal view is it's going to be fairly weak, because the problems that these banks face were not that they went out and made bad loans. The problem that these banks face is they went out and took a lot of interest rate risk.
Bill, were you satisfied with the explanations or the answers to the questions about the supervisory of some of these banking institutions that have failed?
Well, I don't think the Fed is, taken the full responsibility for being pretty slow on this process. I mean, if you go back and look at the November financial stability report, which I did this morning, there's basically no mention of any kind of interest rate risk mismatch, any kind of potential liquidity problem in the bank. So it wasn't just a question of the supervision not being more aggressive with Silicon Valley Bank. I think the Fed basically missed the risk here that deposits could flow out very, very quickly because of the mark-to-market losses on some of these banks' balance sheets.
Do you think then, Bill, they're still missing it, that they don't appreciate the full extent of it based on, for example, the preliminary look that they got of the senior loan officer opinion survey, which seemed to indicate just an ongoing trend of what they had seen? Are they underappreciating a new pressure in the market?
I think that his answer on the senior loan officer survey, it was that it's moving in the same direction that it was upward, the tightening of credit conditions, but not in a way that would suggest that the problems of the banking system since mid-March have led to a significant further tightening of credit conditions. So I think he's basically saying there's not really any new information in the senior loan officer survey. That was my sense of his response to that question.
Dr. Dudley, what you just said is extraordinary. You said basically the Fed missed the ramifications of new digital technology, the speed with which we can move deposits out. A delicate question, if I may, Bill, and that is basically they want Mary Daly's head. There's no other way to put it nicely. You've had experience being a president of a Fed. Do you go after the president of any given regional Fed when there's a major blow-up like this? Or is it much more down the food chain, looking at the process of supervision and regulation?
I think it's a much broader issue about supervisors finding problems with banks and then not forcing the banks to remedy those problems in a timely way. The second issue here was I think the Fed broadly missed the fact that this interest rate risk that they had created by being very late to tighten monetary policy, that they created by flooding the bank with deposits by doing quantitative easing, that they created part of the stress on the banking system that arose when they had to tighten monetary policy by 5% in a little over a year. So the Federal Reserve has some culpability here, both in terms of the monetary policies that they pursued over the last few years, and also on the supervisory side.
It's certainly culpability they're not really looking to go out and acknowledge in a major way, that's for sure, based on some of the statements we've heard.
They have to a degree. I mean, I thought the Fed report from Michael Barr that came out last week did acknowledge that there was a lot of improvement on the supervisory side that needed to be made. But I don't think the Fed has acknowledged the fact that the monetary policy regime that they followed, which was to be purposefully late in tightening monetary policy, meant you were encouraging banks to take on more interest rate risk. And then those banks got caught, and the Federal Reserve had to raise rates by 500 basis points.
Well, that's an assessment your successor at the New York Fed certainly doesn't share, based on his most recent comments. Mike McKee's run out of the news conference to catch up with us. Mike, wonderful questioning to the chairman, as always, in the news conference. Thank you for that on behalf of the whole audience. Really pressing him on those rate cuts, Mike. What was your assessment of what you heard in the last 60 minutes?
Well, I think basically what we heard was the Fed saying we don't know exactly what we're going to do, so we're going to play it carefully, and we will punt on a decision or on forward guidance for now until we get a better read on the economy. Powell was at pains to say his own personal opinion is we're not going to see a recession, but he also ruled out rate cuts in case somebody is thinking that they might do that soon. So a very cautious Fed here. If I could, I'd like to ask Bill Dudley a question if he's still with us about that, because the data don't change a whole lot in 6 weeks. What would be the bar for the Fed, since you've been in those meetings, for the Fed to raise rates, to change its mind, to say we need to do more? What would they need to see?
I think they have to see evidence that the economy isn't slowing, that the labor market's not loosening, that wages aren't coming down, that core inflation's not falling. I mean, at the end of the day, what they're trying to do is assess what is sufficiently restrictive in order to get inflation back down to 2%. Before the banking system problems, they thought sufficiently restrictive was higher than what we are today. And in fact, Powell was talking about potentially even doing a 50 basis point rate hike not too long ago. And then the banking problems hit. And so that's caused the Fed to lower their estimate of what sufficiently restrictive is. So the data will inform them about what sufficiently restrictive is. If the data is really strong, they'll revise up their notion of what sufficiently restrictive is.
Well, Bill, are they going to put more weight on financial sector data, or are they going to put more weight on the data coming from traditional indicators?
I think they're going to put a lot of weight on what they're seeing in terms of the labor market, wages, and inflation. That's really where they haven't made much progress yet. They're also going to probably take some signal by what's happening in the housing sector, because if you look at the single-family housing sector, it looks like it's actually stabilizing. So the policy restraint that's already been put in place looks like the effects of that on housing are starting to fade.
Bill, just a final question from us all. This is something Mike McKee's brought up over the last week in my conversations with him, whether this would be a nod to June 2006. You obviously have a deep understanding of the history of the Federal Reserve. Back in June 2006, they wrote in the statement, the extent and timing of any additional firming that may be needed to address these risks will depend on the evolution of the outlook and et cetera, inflation and economic growth implied by incoming information. Now, Bill, do you think it's a deliberate nod to June 2006 when essentially that decision ended up being a pause?
No, I don't think they know yet. I think Powell was being very honest when he said that we haven't made any decision about whether we're going to pause yet. I think they think that the probability is higher that they're going to pause, but they haven't actually got there yet.
Bill, thanks for that. Wonderful to get your perspective. Bill Dudley there on the latest from Bloomberg Opinion, and of course, the former New York Fed president on this Federal Reserve decision. If you are just tuning in, welcome to the program on TV and radio. Special coverage here, Bloomberg Surveillance, after hours, late. very late. Tom Keene, Lisa Bramett, Jonathan Ferro. After hours at like 3 p.m., which is bedtime.
It's brought to you by LL Bean. We got a pup tent over
The
here.
equity
We're doing
market,
fine.
negative 0.6% on the S&P. TK in the bond market. We're down 7 basis points now. The 2-year right now, 3.88.
Equities give way. There's no question about it. I've been looking at Apple. We'll get to that tomorrow. But, John, what Dr. Dudley said there is extraordinary. He did not mince any words about this institution missing the effect, the slew, the Newtonian rates of change of the interest rate move. And there hasn't been enough talk about this. You can do it on a Bloomberg terminal. It's in your face. And to hear that from Bill Dudley, I don't care that he's an ex-official. That was a scathing rebuke of his institution.
Failed on regulatory oversight. To some extent, there's been an acknowledgement of that in the most recent report. One. But two, to your point, they increased interest rates aggressively from 0 to 5. They weren't front-loading. They were catching up. And because they had to catch up, you've had this rate shock. And that's what Bill Dudley is talking about.
I know we got to get to Jeff Rosenberg, but basically, folks, this is Bramo and Farrell all wound up, and me and McKee are more institutionally friendly. I'm sorry, some of the people that...
Let me clean up what you just said. What you mean by that, and I'll leave Mike out of this, is that you have the establishment view.
Yeah,
and that we're questioning it.
You know, it's like 2020. They put their pants on one leg at a time, like everybody else. But the bottom line is, here's a guy with immense experience. Bill was in my book. Blah blah blah. Great. He was scathing about his institution.
Debt crises always happen in instruments that are thought of as safe. That is always what has happened. Back in 2007, 2008, it was the AAA rated debt that was tied to mortgages that were basically bundled together. So here's the question. Has this Federal Reserve, and frankly, regulators more generally, just let me finish, have they basically assumed a complete lack of risk in some of the benchmark treasuries that they're using as like the safety pools, as the buffers? Yeah. And this really, if it's not appreciated, how much further does it potentially go?
You can tell it's getting late. You know, Bramo's slowly losing it with you, TK.
Pacific West easing into the close. I'm sorry, Pacific West is giving me a 7 down to 6.52. And when you see people like this with this language, it's enough to make, Jeff Rosenberg's going to get his first gray hair.
Jeff's waiting for us. That's why he's aging. Jeff Rosenberg of BlackRock joins us right now. Jeff, you followed all of that, not this, all of that meeting the news conference with Chairman Powell. Jeff, your takeaway, please.
Yeah, I've got 3 key takeaways here. First thing is, when you just look at the totality of this is pretty much on spot on for market expectations. The statement all but basically admits to this is a pause. In the press conference, he tried really hard to not say that, but to say that, and I think it's pretty clear that that's where we're at. Second thing that I took away, I'll call it the new Powell arithmetic as to how he gets to the pause in that policy is sufficiently restrictive. And so what is that new arithmetic? It's the nominal rate minus 3% inflation gets you to a 2% real rate. Add to that credit tightening and add to that QT, and that's how he gets to sufficiently restrictive. And so I think when we look forward, it's really going to be the assessment on this arithmetic towards sufficiently restrictive. First of all, is 3% the right inflation rate to subtract from that nominal rate? If inflation stays high, that real rate isn't as tight as he's implying. Second piece is, and he admitted this, we don't really know the magnitude of this credit tightening. We only know the directionality. And the third piece is, how much is QT really generating sufficient tightening in the real economy remains kind of very unclear. And the third key takeaway here, and he talked about this, and Mike McKee, great question, because you got this out of him. What about rate cuts in the market? And he highlighted that's the difference between the market inflation forecast, which is a very aggressive decline back down to 2%, versus the Fed's forecast, which is for a much more gradual inflation decline. And that's what separates market expectations for Fed cuts from the Fed's reiteration again here that they will hold rates at this level for a long period of time, in contrast to market expectations. So it gets us back to a focus on the inflation data.
Is your sense, Jeff, that we just witnessed the last rate hike in this cycle?
Well, I think we've seen the last rate hike in the consecutive rate hikes. I think there's a pause, and now it's a pause for validation to what I was just describing. Is this really sufficiently restrictive? There was some acknowledgement by the chairman in the data that suggests some uncertainty, that we're not seeing the degree of tightening in the labor market commensurate with a 5% increase in interest rates. We're not yet seeing critical measures of inflation in that services ex housing inflation coming down at a pace consistent with the attainment of a 2% goal. So these are kind of the cautionary tales around, and even the statement in the language says, you know, we're not moving towards cuts next, we're just pausing. But that doesn't mean that the full cycle is ended and we can claim success. That is going to be about the evolution and the data.
Jeff, do you have confidence that the Fed truly does have a handle on what's going on in the regional banks, given what they acknowledge was some pretty significant oversights, and based on what you see in the granular data that you study every single day in order to make trades?
Well, I think, you know, the anatomy of a banking crisis is very hard to assess, you know, whether it's done. He got the question. He was very careful about answering it. You know, I think it's clear that this first phase, when he identified the 3 problematic banks now being under resolution, that putting sort of a line under the first phase, you know, and I think that's the case. We can see that in the data. You can see that in the deposit flows. I think he's very reticent to make too big and too large of a blanket statement on that, given the uncertainties that we associate with banking crises. I think the second thing is really the critical one, and that is not the direction of credit tightening. Yes, this is tightened credit. It's important to note, and he highlighted this in the upcoming SLOOS, as well as in the Beige Book data, we had seen tightening in credit conditions already in place before the March banking crisis. What's unclear here and very hard to measure is what on the margin has this done to accelerate that relative to trends that were already in place for a 500 basis point tightening. And as he admitted, with honesty and humility, very hard to make that assessment. And I think that's the right assessment in terms of the magnitude of the quantity of the credit tightening.
And Jeff, we're seeing the banks roll over here as well. Keefe Bruyette and Woods index moves down to new lows back to 2020. And I also would point PacWest moving over just as one of the banks having a tough afternoon of it. Jeff Rosenberg, the fact is what I'm looking at is a 3-month, 10-year spread, the short T-bill versus the benchmark. It's truly in the cliches uncharted territory. It is out 5.4 fitted standard deviations with a velocity to an ever greater inversion. Which part of that barbell matters? Looking at the 3-month dynamic or looking at the 10-year dynamic?
You're going to hate this answer, Tom, but you know, both matter, and they're telling you different stories, right? The front end is telling you about the extent of where we are in terms of policy, and the tightening that has happened. The long end is telling you about the confidence in the market forecast for inflation to turn right back down to 2%. You can also argue, and I think there's merit to these arguments, that there's some risk premium in there. There's some tail risk scenarios that are reflected in the 10-year. There is the expectation for the Fed to react to those kind of growth shock, tail risk shock by easing monetary policy. Right. And there's a forecast here that inflation goes right back down to 2% pretty aggressively. So I think that's what's the message of that deep inversion. You know, you can also say that that's telling you that you're not going to get that inflation decline without a deeper recession than, say, Powell is forecasting. So all those things are implicit in that amount of curve.
What's
inversion.
important here, Lisa, is we're going to standard deviation analysis. It seems like not every chart, but half the charts I'm looking at, I'm now looking at the size of the move given the trend, which is what you do with standard deviations. And frankly, that's what you do on the edge in crisis, coming out of crisis. I mean, that's sort of the tone here you get, again, with SPX off 23 points.
And PacWest down 4%, a similar kind of move. in Western Alliance shares as we degrade heading into the close. I do wonder, Jeff, your comment on Drew Mattis's point, Drew Mattis of MetLife. He wrote in saying, what a missed opportunity to provide relief to the banks. An unexpected pause could have flushed out shorts in the sector and created more breathing room. What is your view, Jeff? Do you think that this was a missed opportunity to throw a lifeline to some of these spiraling prices that we've seen in the regional banking sector?
You know, he sort of got that question a little bit, you know, when he got the question, why didn't you pause? And he gave an answer that was about getting to sufficiently restrictive. But I think the subtext, which he didn't discuss, but I think it is something that is important, is the potential for creating an overreaction by financial markets, right? So he was very much taking pains to not use the word pause, leading you basically up to it without saying it. And I think that was pre-scripted, again, to avoid what we had seen in other FOMC press conferences, an overreaction, a too large of an easing in financial conditions, right? So remember, the Fed's perspective here is we haven't won the battle on inflation. Inflation is still way too high, 4.6% on core PCE. So they don't want to give the market any reason to ease the financial conditions tightening. And I think the pause and the early pause, and yeah, there's a banking system perspective on that, but there's the broader system perspective, and that the tightening in credit conditions is actually aligned with their inflation objectives. And so they don't want to push too far back against that and create an unintended easing in financial conditions at this point in the inflation fighting, which is not yet won.
You need a PhD in psychology. Jeff Rosenberg of BlackRock. Jeff, thank you, sir.
Yeah. No, that's
Thank you
accurate.
very much.
That's accurate.
Talking about surveillance, you're talking about
all of the above,
game theory.
Your equity
that we
market
hear.
breaking down a little bit here, I've got to say. PacWest is down about 3.8% or so. Western Alliance is negative as well. We're down 2 there by 4%. The equity market breaking down on the S&P by 0.6%. Here's a final line from Thomas Thornton of hedge fund Telemetry. No rate cuts for you. Seems to be the takeaway right now. Going into the close, here's some coverage for you. Seema Shah, Chief Global Strategist at Principal Asset Management alongside Scala Fu and Romain Bostic. Looking forward to their conversation. Tomorrow morning on Bloomberg Surveillance, Ben Laidler, Jane Foley, Wei Li. We go from the Federal Reserve to the ECB tomorrow. Apple after the close on Thursday, then onto payrolls. From New York City, thank you for choosing Bloomberg TV and radio. This was Bloomberg Surveillance. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry
at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
News breaks. No one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Special extended coverage of the Fed decision continuing right now. A 1/4 percentage point increase in rates today. The 10th consecutive rate hike by the Fed, taking the target from effectively 0 to a range of 5 to 5.25% in just about a year's time. Past Fed statements in this tightening cycle did make clear that, quote, some additional policy firming may be warranted. That language absent in the latest release, so maybe, just maybe, the Fed pause the market has been pining for is finally here. U.S. equities fluctuating, giving up some of the earlier gains. Treasuries being bought, a 2-year yield back below 3.9%. Scarlett Fu will be joining me as we count you down to the closing bells from Bloomberg headquarters in New York. But I'm Romaine Bostic here in Beverly Hills, California at the Milken Institute Global Conference. Bi-coastal coverage of the reaction to the latest from the FOMC. And we start with Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, great to see you.
Great to be here.
We got the 25 basis points. I don't think that was much of a surprise. They removed some of the language about potential rate hikes going forward. Were you surprised by that?
No, not at all. I mean, I think the language was given the idea that they could be at a pause, but they really have kept the door firmly open that you could have another rate hike next month. He's confirmed that there's data dependency. We knew that already, but I think that confirmation, given the volatility we've been seeing with the banking sector around the debt limit, that was important knowledge. But also during the press conference, he really did push back at this idea that they could be rate cuts. Now, we've been hearing that time and time again, obviously for the last 12 months or so. But I think as we're getting close to that, I think the market still has to hear that. Take into account that rate cuts, unless you have a worst case scenario of a severe rise in unemployment, a severe financial crisis, rate cuts are not on the agenda for this year.
And I think it was interesting. One of the questions during the press conference was about this idea that as you get inflation down maybe to that 3% level, would that be enough for the Fed? And he kind of made it clear, we get to 3%, we're not dropping our toolkit there.
Right, and you know, there's two messages there. One is, to indicate that they are in there for the long game. 2% is the full target. But the other message that he was giving there is trying to tell the doomsayers that they're going to shift away from a 2% target. He's telling them that they are committed to 2%. There's not going to be a shift to 3% or even a leak up to 3%. So I think that gives us an idea. But the other thing was, he didn't say 2% this year. He did say it's going to take some time. So that does add maybe a little bit of dovishness into his message.
I'm curious. Obviously, he reiterates the idea of being data dependent. You had a panel a little bit earlier here at Milken about macro conditions here. What is the data telling us right now? Are we seeing a strong economy, a resilient economy, or are we seeing something that's maybe headed towards more softness?
Well, so look, if we look around, it's very robust. Right, consumer spending is still strong. You see it also from the Q1 data. But also, if you look under the surface, you can see that strains are starting to come through. And now with the banking crisis, the thing that's not visible today, but is likely to become more visible as you get through the months, is that there is going to be credit compression. There is going to be a slowdown. And with credit compression comes job losses. So it looks okay today, but we're looking at a slowdown in the future, which is a difficult thing for the Fed to appraise right now.
Well, we talk about those long and variable lags, and we get a big U.S. jobs report this Friday here. When do we start to see more of the effects of that lag? I know we maybe potentially saw it with the regional banking crisis, but when did that really materially start to show up in the labor market?
So we don't think it happens until at least Q3 of this year. Once it starts, so typically it spirals pretty quickly. So although it hasn't taken place right now, that is no given certainty that it's not going to happen. So Q3 comes, we expect to see further job losses, and then it spirals, and you see that rise in the unemployment rate that the Fed themselves have been talking about with that 4.5% unemployment projection.
When you see what the Fed is doing here, we have an ECB meeting tomorrow. They're, I think, on their way to, a 7th straight hike. There's a lot of concern here about what central banks are doing, their mandates that they have, and maybe whether those mandates are too narrow. Are you comfortable with the communication we've gotten out of them?
Look, I think that they've got a really difficult situation here with communicating. They have a price stability target, they have a financial stability target. Unfortunately, at these points, not always, but at these moments, they are absolutely on combat with each other. So I think they're having to toe a very difficult line. It makes it very difficult, given that the lag of the system means that they have to wait for price stability, but in the meantime, that could be increasing financial instability. I think it's difficult. I am expecting the ECB to raise rates further tomorrow, of course, and a couple more to come down the line. In the meantime, they may be seeing further strains in the financial markets, but I think that's unfortunately a cost that the central bank, with its current mandate, will have to take on.
And then there's, of course, the banking situation, we'll call it, not necessarily a crisis, but issues in Europe, of course, issues here with regional banks. Powell made it clear that this did come up during the meeting today. There was a discussion about the risk associated with that, but they didn't make any meaningful decision about how to factor that into policy.
Right, and I think that's important. Look, if they had paused today, then I think it would have given a message of panic, of major concern that actually isn't yet priced in. So I think that that would have been a worst case scenario, in fact. But now they have to wait and see. Unfortunately, with these things, it's a lot of its behavioral impact. How are people responding? What can the FDIC do in the next couple of days to resume that confidence that they desperately need? So they are, on a case-by-case basis, again, very data-dependent, which makes it difficult for the Fed to move forward right here.
Seema, great insight. Great to catch up with you here at Milken on a very busy day with the big Fed decision. Seema Shah, Chief Global Strategist at Principal Asset Management. We are counting you down to the closing bells. A mixed market, from my view, here in Los Angeles, Beverly Hills. Let's go back to New York, where Scarlett has a better read on what's going on.
Yeah, mixed market certainly when you look within equities, because the Russell 2000 is still positive, yet the S&P, Dow, and NASDAQ have turned negative and continue to steadily decline through Jay Powell's news conference today. So stocks settling on a direction that is down on the expectation that the Fed will likely pause, or there is a possible pause, but no specific indication of a rate cut anytime soon. When you look at two-year yields, we are seeing those yields declining. For the two-year yield, down to 3.85% right now. The dollar falling short for a second day. It's brought its year-to-date losses to about 15%. And look at oil prices. NYMEX oil down by 4.8%, falling below $69 a barrel. Traders say that the energy market is pricing in recessionary concerns right now. Also, let's take a look at some individual names as well, because Meta is a really interesting one. It erased its gain after the FTC proposed limiting Meta from using facial recognition technology or monetizing kids' data, as well as imposing a possible ban on new social media products. And the reason is because FTC says Meta has repeatedly violated privacy promises. Estee Lauder, the worst performer in the S&P 500, and now sees sales falling 10 to 12% this fiscal year, blaming a slower than expected travel recovery in China. Interesting one. And Eli Lilly, I wanted to include a gainer here. It's up 6.5% right now. Fairly encouraging results from the final stage trial of its experimental Alzheimer's drug. So the results show that the treatment slowed the disease by about 35% over the past 1.5 years for a small subset of patients. patients. And these results help pave the way for Eli Lilly to apply for U.S. approval of the drug. Certainly encouraging for anyone who's been watching the efforts to try to find treatment for Alzheimer's. And of course, we are keeping a very close eye on those regional banks. KRE, this is the ETF that tracks regional banks. They are regrouping, or I should say recouping, some of yesterday's plunge. But even with today's advance, they're still down about 7% this week. So that's how things stand right now in the markets. As we get you closer to the closing bell, we've got full market coverage right here on Bloomberg as we take you to the bell and beyond. This is Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Carol Master, live from the Milken Institute Global Conference in Beverly Hills. We're counting you down to the close. Just about 2 minutes to go here. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. There was a lot of green on the screen heading into that Fed decision at 2 p.m. Eastern. A lot of red on the screen now that this decision has been made.
Yeah, and we're still continuing to see worries in terms of some of the regional bank stocks. What I find fascinating, Romaine, we've been talking so much leading up to this meeting, and after all is said and done, ultimately the Fed is still data dependent. Yes, maybe a hawkish pause, but nonetheless, do they think that they could potentially have to do more? They could.
A hawkish pause. Are you trademarking that? Because I think Jay Powell made it clear they're not pausing.
No.
He said that that really wasn't the discussion today, or at least no definitive agreement was made today. But he did make it clear that was on the table for the mid-June meeting.
Well, and pauses were talked about by the Fed members, yes, even though they said not for this meeting in particular. And I do feel like, once again, we got kind of the initial statement, and maybe there was a thinking, okay, a pause more likely. And then once you got into the press conference and Mike's question, a different feel.
Well, it was a different question, and a good question. But here's my question to you, Carol.
Yeah.
What is the case for a pause? Because if you say they're data dependent, I'm looking at ADP data we got this morning, big jobs report this weekend. We've seen other data here. That's not the inflationary, the deflationary environment that he's looking for.
Absolutely, and he also said 2%. That's our inflation target.
Yeah.
He asked about.
Did you hear when someone asked him about 3%?
And he's like,
he said, "We ain't dropping the toolkit at 3%. Are you crazy?" He didn't say, "Are you crazy?" But that was what he had in his eyes.
And the inflation that he really looks at. You have that kind of mind meld with Jay Powell, apparently.
Carol, I mean, I do think, though, that the market reaction is interesting.
Yeah.
Believe it or not, the market reaction, I do think, was a little more subdued.
Absolutely.
Even though we did erase all of those gains. But the idea here that we've really been in stasis for quite some time. You can see those numbers on your screen right now. I know Scarlett Fu's back in our global headquarters in New York with a better read here on where we stand right now with the closing bell. Scarlett.
Yeah, let's take you through the closing numbers here. We have the S&P 500 losing 0.7%, the Dow coming in off 0.8%, and the Nasdaq losing 0.5%. The Russell 2000, actually the lone gainer here, gaining 0.4%. When you look at the industry performers here in the S&P 500 by 24 industry groups, it's overwhelmingly red. There are 4 sectors that did finish in the green, but by and large, it's due to a couple of individual names. Autos like Tesla and Ford did particularly well. You also have commercial and professional services. This is Verisk Analytics, which provides data to the insurance industry, as a big winner. And then Whirlpool and Garmin helping lift the consumer durables and apparel index, and a couple of biotech names as well. But on the downside, Yum and Starbucks helping drag lower the consumer services companies. Energy companies also losing 1.9% on the drop in oil prices, as well as the banks index losing 1.7%, as you guys were just discussing. All right, let's get to Qualcomm's results. This is the chip maker based in San Diego. Second quarter adjusted EPS of $2.15 matches the average analyst estimate. In terms of revenue for the period, $9.27 billion is better than the expected $9.09 billion. When it comes to its outlook, the third quarter revenue forecast is anywhere from $8.1 billion to $8.9 billion. That is a big miss from the expected $9.25 billion that analysts were forecasting. And so what that indicates is that the smartphone slump will continue to drag on. In terms of adjusted earnings per share for this quarter, Qualcomm sees $1.70 to $1.90. Analysts were looking for $2.20 $1.20. So while the second quarter numbers look like a beat, the third quarter outlook is where Qualcomm falls short, and you're seeing the stock extend and deepen its losses right now, and after hours trading losing about 5% right now. Carol and Romain will continue to keep an eye on what's going on with these after-hour stocks. Back to you.
A good reminder, of course, that this market isn't just driven by the macro, Carol. It's also, of course, driven by the micro. Those earnings still coming in. But tied into that, of course, is overall economic conditions, business conditions. We talk about the banking sector, whether there's going to be a retrenchment in lending. Powell came out. Remember, he said, let me start here first, addressing the banking sector. In his words, it's sound, but he also made it clear the FOMC, the policy members, did have a pretty interesting discussion about the risk posed.
No, absolutely, which is really interesting. And I think that kind of mirrors some of the conversations that we've heard here, and certainly from the private credit area or private lending area, that they are seeing an uptick in demand because banks are holding back. Powell talked specifically, talked about credit tightening impact and how that will definitely have an impact on the economy. And I think it just reminds us that we are not sure if we are out of the woods yet when it comes to pressures, but we are definitely seeing the slowdown in lending, right?
Yeah.
And that is going to impact the economy and the slowdown.
Well, it'd be interesting, though, but is that going to be a contraction in lending or just a slowdown in growth? Because he was asked about this. He mentioned the senior loan officer survey, which comes out next week, which presumably they would have a little insight into prior. And he said that growth has slowed, but he also said it's still lending growth is still growing.
He said he didn't think recession, right? Also, in general, but he said he wouldn't necessarily rule it out as well, which I really feel like he's really reminding us that they're going to be looking at the data.
Right.
And I also thought it was interesting that he said he didn't agree with some of the Fed staff in terms of their economic projections.
I thought that was interesting.
Yeah,
but that's not abnormal, we should point out. We've seen this in the past.
Yeah.
The staff is usually a little bit more aggressive.
But they were the ones that kind of planted the rate cuts, right, early on.
Yes.
And which he quickly kind of smacked down when Mike McKee asked about it, saying we don't think that that's appropriate considering our inflationary targets.
Right, but then, and it gets back to that dual mandate, which is really 3 mandates, but everyone says dual mandates. But the idea here that is their focus.
Right.
He's been challenged on this so many times. I mean, we talk about coming in today, that letter that was sent out by Senator Warren and a few other Democrat lawmakers basically saying you need to stop this, not necessarily because of the data being dependent, that the idea here that there is economic pain out there that maybe isn't showing up in that data and they need to be mindful of. He said, look, I see the pain, I feel the pain, but we got a mandate and we're going to stick to it.
You know, both of us are talking to John Hope Bryant, which is something that he works with financial literacy and really helping folks get into homes that couldn't otherwise tap into the financial system. He's going to talk about, you know, that's one of his concerns. These higher rates are certainly making it more difficult for individuals, maybe with lower incomes, you know, to get into